supply in the U.S. is negative. That's a leading indicator of inflation. We are forecasting inflation goes down to 2%, rates drop, stock market's pretty strong. That's a great environment for preferreds.
Hello, you're watching Proactive. Joining me in the studio is Jay Hatfield. He's the Chief Investments Officer of Infrastructure Capital Preferred Income UCITS ETF. Jay, very good to have you in the studio. So Jay, before we get into the ETF itself, give us a little bit of your background, please.
Thanks, Stephen. It's great to be on. I've been on Wall Street for 37 short years since I graduated from Wharton Business School in finance. And about half that time as an investment banker doing utilities and pipelines. So I've been more focused on the old economy. And then the next half of my career, worked at 2 large hedge funds. Then I started my own firm. I founded an energy company, trades on a New York Stock Exchange, and then launched our hedge fund and our ETF business. And we currently have 7 ETFs in our ETF business.
In fact, Infrastructure Capital manages over $3.5 billion in assets. Can you discuss your investment philosophy, Jay?
Well, we believe that having income in your portfolio or one's portfolio is a great strategy, particularly if you're older or more conservative and looking forward to retirement. Because the great thing about income, even if it doesn't cover all of your needs for cash, if it reduces it, then it reduces the risk that you have to liquidate your portfolio during a downturn. So let's say even you have half of your expenses covered by income, it could be equity income or fixed income. Then during a downdraft, you only have to sell half as many securities. It'd be great to have it all covered. So a lot of investors don't focus on that. But it's critical, we believe, to have income, to have security when you're investing your own money.
So tell us a little bit about the Preferred Income UCITS ETF and what's in there.
Mm-hmm. Well, these are only U.S. or at least North American, there's a little bit of Canadian securities. We think it's a great asset class. They're listed securities, so they trade on stock exchange, which is important because there's a lower bid-ask spread and retail investors can buy them directly as well. But even more importantly, they're issued by public companies. There's been a lot of discussion about private credit. We're suspicious of private credit. We don't know those companies. They don't have to report the SEC. They can't issue public equity. Conversely, these public companies care about their credit. They're stable. They're usually well run. They have large market caps, can issue equity. So we think it's an attractive asset class. You get paid before common. It's a fixed amount, so it's fixed income. It has a little bit of volatility, but not nearly as much as stock market. So a good way to generate stable income and good total returns.
Is now a good environment to invest in those preferred income ETFs?
Well, when you want to assess the economy, it's 99.9% about, in the US, the Federal Reserve, or globally, the central bank. A lot of times investors will blame, or voters blame, the president for the cycle, but it's really the central bank. So you want to buy preferreds when there's a rate cutting cycle. Europe is done with their rate cutting cycle, but we're not in the US. We have about 3 cuts left. That's when they tend to rally back to par. So you get not just the coupon, but total appreciation. Then you get close to par. And then to be fair, at some point you might want to trim that because eventually we're going to have a tightening cycle, probably 4 or 5 years out. So it's always attracted by preferreds, but if you want total return, now is a good time to do it because you're in a Fed or central bank cutting cycle.
How can active managers use listed preferred stocks to their advantage?
Mm-hmm. Well, if you do buy them directly or through an index, if you buy them directly, you have to manage a number of risks that you don't with equities. So with equities, you can just buy, if it's a good company, you can buy McDonald's and just hold it till you die. But with preferreds, you have to manage credit risk. You don't have unlimited upside, so you want to make sure that you are in solid credits. If they start trading above par, you want to trim them. So equities don't have pars, they're not callable. So you don't have to manage that. And then it's important to play the interest rate cycle. So if rates are rising, it's like they were in 22, you want to be more in floating, That's what we did with our fund, more floating rate, higher coupons. So those risks need to be managed. And index funds are not good because they have to rebalance. They rebalance on a market cap weighted basis. We take advantage of that. So active management, not just with preferreds, but all fixed income is really required. It's not really required for equities because sometimes the worst equities do the best because of momentum, but that doesn't work in fixed income.
So I noticed that the infrastructure capital preferred income UCITS ETF has a distribution rate of over 8%. How do you construct the portfolio to achieve that high yield, Jay?
Well, we look for solid credits where the bonds are investment grade. So high quality bond issuer. The rating agencies don't like preferreds. We think they're wrong. And they penalize the preferreds so they're not investment grade or double B, so you get much higher yields. And we look for companies that have strong assets, have significant market cap, so they can either sell assets or issue equity to protect the credit of the preferreds, and they have to be public. Public companies care about their credit, private companies often don't, and are usually way lower quality companies.
I see you caught the attention of President Trump. You appeared on Fox News last year. He's calling you a markets and economic expert. So give us your thoughts at the moment about the economy.
Well, we've been a harsh Fed critic for really since early 21 because our Fed missed the fact that they're increasing the money supply by 70% was causing this huge inflation. It was very obvious. If you want to call the economy, you look at the central bank, what are they doing to money supply and housing? So they missed that. So we've been a harsh critic for 3 years. And so we continued that criticism on Fox, and the president had become, so he really stole it from us, probably not, but had become a harsh critic of them. And so that's where we got the attention. But I was trained as a monetary economist. There's very few left. It's really, at least has tremendous value. You don't have to be 100%. And so that's why we're bullish about rates right now. The money supply in the US is negative. That's a leading indicator of inflation. We are forecasting inflation goes down to 2%, rates drop, stock market's pretty strong. That's a great environment for preferreds.
Tell us about some of the risks. So if investors are looking at preferreds now in this great environment, what are the risks that they may face?
So the main risk is that we're wrong. And so in other words, that we're wrong about inflation, we're wrong about rates, we're wrong about the stock market. But what's nice about preferreds is they do, as you indicated, they do typically have pretty substantial yields. So small problems over long periods of time get wiped out. So we launched our flagship fund in the US, it's not traded here, 8 years ago. It was kind of a bad time to launch it prior to the pandemic, prior to a lot of irrational central bank activity, high inflation, but it still averaged 8% returns over 8 years. And that's really mostly the coupon. And so the coupon covers up for some market volatility, even if you're taking currency risk. Usually currency movements are pretty small. Like I looked it up for our flagship fund in the US, like the British pound has been exactly, it's just by accident, exactly equal over those 8 years. Like it's gone up and down and up and down, up and down, but usually currency is pretty stable. So with higher coupons, even if we're wrong about the environment, stock market's weaker, spreads widen a little bit, rates go up a little bit, you're still getting 8.5% yields. Just hold on. Pretty soon, any small mark-to-market drop gets offset by the coupon.
Well, let's hope you're not wrong. Thank you very much, Jay, for coming through.
Thanks, Stephen. It's great to be on.
That's Jay Hatfield. He's the Chief Investments Officer of the Infrastructure Capital Preferred Income UCITS ETF.